Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and today we're getting an update on Ecora Resources, traded on the TSX under the ticker ECOR, and on the LSE under the same ticker, ECOR, and for U.S. investors on the OTC markets under the ticker ECRAF. And we're joined today with the CEO and Executive Director of Ecora Resources, Marc Bishop Laflèche. And Marc, it's great to have you on the show again. We were remarking offline, it's been over a year since we've had you on, so we almost need to reintroduce Ecora Resources to folks listening in. And just from a high level, I'd love you just to give the value proposition of where you sit in the royalty spectrum. I will just start it off by saying that you're a diversified royalty company. So while you're not opposed to having precious metals exposure, you're really focused on a lot of other metals and in a lot of different jurisdictions. So give us a high level overview of the company just to kick things off today.
Absolutely. And it's great to be back on the show. Well, okay, how do we boil down Ecora to 1 minute? Ecora, in a nutshell, is a royalty company focused on industrial commodities that have a role to play in the energy transition thematic. And therefore, that includes renewable or low carbon energy production, the transmission of that energy, or the consumption or storage of electric energy. And we've taken a portfolio that historically was very heavily weighted towards met coal, which has been a great royalty. It's a Kestrel royalty and it's generated a lot of income. We've always known that that royalty would be materially depleted, by the end of sometime in this decade. Now it looks like the end of 2026. So our challenge historically has been to rebuild a portfolio such that as Kestrel runs out, we have a stable line of income and additionally a growth profile. And so we've spent the better part of a decade now pivoting our portfolio to these industrial commodities that you mentioned, things like copper, nickel, cobalt, uranium, vanadium. And as of today, actually, we added a rare earths royalty to provide investors with a way who like the thematic, but are looking for a relatively more de-risked way to play it, to do it via the royalty model and via Ecora. So, I mean, it's hard to believe it's been a year since we last spoke. A lot has changed. But it's great to be back, as I said, and just talk you through where we are today.
Yeah, Marc, I think it's a very interesting time to be looking at a lot of these strategic metals and critical minerals. And you've got a nice basket of royalties and good operating partners, and we'll dig into some of them. I guess I want to start off with copper because we hear all the time people saying, well, how should we get exposure to copper? If I'm in these drill plays or these development companies, the concern is they never get built and they never get those higher copper prices, although the world does need more copper. If I look at the producers, a lot of them have run big already, but I think a lot of people forget that royalty companies, that's a great way to play it. So maybe just highlight some of the copper assets that you have in the stable.
We couldn't be happier with our copper exposure. 'Cause from a base where we had essentially no material copper exposure to, within the royalty sector anyways, one of the sector's best growth pipelines in the space. From a production perspective, and with a royalty, you can't you look at it purely as production because we have different royalty rates on different projects. But simplistically, our producing copper exposure today is around 50,000 tons, and we have a portfolio within the next decade which has a realistic potential to get to 500,000 tons of exposure. Really strong counterparties and BHP, Capstone Copper, amongst others. Really high quality projects, low cost. So one of the things that I always remind people who like copper exposure is that at Ecora today, actually, you can get that copper exposure at a met coal trading multiple. It's just a fantastic entry point if someone is really bullish on copper. And even if you're not bullish on copper, not that much of our development royalty portfolio is actually priced into our equity today. But if you look at broker NAV estimates, so on that basis, a lot of our copper exposure, one could argue, is arguably free.
Yeah, you get some of the producing assets that may be factored in, but all the development stage assets coming down the pipeline and de-risking projects are not being valued currently. And so you have that upside potential. And I was just looking at a slide in your slide deck, and I do encourage people listening to go pull up the slide deck and have a look through it. But you show your metals exposure, and copper is around 33%. So you could say roughly a third of the metals exposure, at least at present, is to copper. So it's a great way to play the copper bull market. But there's some other metals in here that I also find interesting, and maybe we can talk about them just together as a group. Something like cobalt or vanadium or even nickel. people struggle to find individual companies to invest in, or they don't want to take that individual company risk. But here you're providing access and exposure to some of these metals. So maybe just speak to some of the partners that you have with things like cobalt or vanadium or nickel.
That's actually one of the opportunities we have at Ecora that you've really touched on, in that there isn't really a royalty company bigger than us when we're diversified in terms of our commodity basket being so heavily weighted towards those future-facing commodities. So, our view is as we continue to diversify our portfolio and grow, provided that we maintain the same investment discipline, this proposition, the Ecora proposition, is really unique. There isn't really, as you mentioned, a way to get that exposure, certainly not via a de-risked royalty model. And it's possible, of course, to go into equities, but that's a different risk profile entirely in terms of taking, as you mentioned, single asset development risk and so forth. Ecora, as a royalty company, is small in terms of market cap. Our enterprise value is around 300 million, but the folks operating our producing royalties in aggregate have market capitalizations in excess of $200 billion. So it's a nuanced point, but Ecora is not a small cap in trading liquidity and market size, yes, but absolutely not in terms of operational counterparty risk. And then that speaks to the fact that our cobalt exposure is via Vale at a producing mine in Canada, right? Our Capstone exposure in Chile, BHP is developing a royalty over which I think BHP is developing a project over which we have a royalty in Australia. So some real household names. And frankly, that's been, intentional. We've been patient and methodical and disciplined to sort of build up the portfolio asset by asset, all the while maintaining a jurisdiction footprint that is almost 100% OECD. And second, very heavily weighed to assets that are low on the cost curve. With a royalty company, that matters, because if you have a royalty over a mine that's in production, a low cost asset is very likely to stay in production. And if you have a royalty over a development stage project, well, low cost development projects are much more likely to come into production more quickly. So, when you package it together, I think we have a business today that's really interesting, that's trading at an attractive valuation. And we'll keep working at it to keep growing this business, further diversifying it. And we think that as we can continue to diversify the company and frankly, just reduce volatility in the company's earning profile, we should see, what we see elsewhere in the royalty sector, which hopefully is a premium royalty valuation.
One market touched on a couple key points there. I think that it would be nice to expand upon just a little bit further. You mentioned the importance of having those lower cost, best quartile, first and second quartile producers, and also the strength of the operators. You mentioned household names, and they absolutely are. If you think of BHP, it's the biggest mining company on the planet. Vale, you mentioned Capstone. These are some quality partners, and you've got a lot of other partners we haven't even discussed yet. But maybe just speak to the value proposition that a royalty company has by having these quality partners that have low cost operations, the confidence that you can have in future cash flow and future revenues coming into the company.
Yeah, it's in some ways it's a function of discount rate, but in other ways it's a function of absolute risk multiples. So by that I mean, if an asset's in production, one might view those cash flows as being relatively less risky and therefore apply a lower discount rate. But in terms of development assets, it's somewhat binary, or at least it can be binary depending on the stage of development. So if, for example, if a project's in construction, one could assign a much higher probability of those cash flows materializing. If it's a 10, 20-year development pipeline, markets and royalty companies usually, but not always, tend to apply more conservative assumptions.
Well, let's actually talk about some of the projects that are coming down the development pipeline, because right now you've got some interesting slides in your deck on the value that you're receiving, your net asset value, versus where things could be when some of these development projects come into the pipeline. Notably, I guess three big projects, Marc: the BHP West Musgrave project in construction, the Capstone Copper, the Santo Domingo, and then the Brazilian nickel project. Maybe just highlight how those change the game over the next couple of years for the company.
Yeah, they changed the company in two ways. First of all, in terms of the revenue complexion. And by that, I mean, today, I don't know, call it 50-50 met coal, future-facing royalties in terms of portfolio contribution. So as those assets come along, the met coal will have come off, and then our cash flow complexion will be much closer to 100% future-facing commodities, the bulk of which potentially copper. So the first is there are two layers, right? There's just absolute growth, but also the complexion of those cash flows. And what we see in the market, rightly or wrongly, is that met coal cash flows typically attract lower valuation multiples. So, when we look at the Ecora value proposition, first of all, there's just the absolute growth potential that exists. But what's even more interesting is the fact that our closest peer trades, and by the way, this is the closest peer that's not a gold-focused royalty company, but a non-precious business. They trade over 3 times our multiple. So even if we get halfway to their multiple, and when you combine the growth potential and you combine the multiple re-rate potential as our complexion, as the cash flow complexion changes, that right there is a potential doubling of enterprise value or more. So when we look into the future, we're really confident and positive about the asset base that we've put together.
Well, could you give us a little more color on, let's start with the BHP West Musgrave project, where things are at and what kind of commodity exposure you'd have there with BHP?
West Musgrave is a copper nickel project in Australia. At today's spot prices, I don't know, call it 50 to 60% nickel, 40 to 50% copper, with the possibility of getting a lot bigger or having a much longer mine life, primarily concentrated in a copper resource, which is something we love as a royalty company. That project BHP acquired when it merged or acquired Oz Minerals. So Oz Minerals has started the construction of that project. BHP took ownership. It's now over 20% complete. And in the context of softer nickel markets, BHP has indicated they may look to phase CapEx or slow down the development of West Musgrave. That's potentially something that's weighing on our share price currently, although thankfully BHP have indicated that they'll give more visibility on their intentions with regards to that construction schedule with their fiscal year results due in August. So this royalty, at spot probably does on average through the life something like 15 to 20 million per year. And it's one that it could be a contributor for multiple decades once it's in production.
Well, and Mark, the nice thing with BHP is that they have the deep enough pockets to bring this thing into production when they want to, when it's the right timeline as the nickel prices support. And even if they do a phased CapEx on it, BHP is the kind of company you don't have to lose a lot of sleep over worrying whether they can bring it into fruition. Let's also touch quickly on the Capstone Copper and Brazilian nickel development projects that are slated to really go into production more like 2027, 2028, and what that will mean over the next couple of years on the production profile with those two assets.
Santo Domingo is an asset that's located, 20 to 30 kilometers away from a producing Capstone copper mine called Manto Verde. And what that means is there's enormous synergy potential to the Santo Domingo project by virtue of shared infrastructure, for example, the shared use of an existing desalination plant. So based on Capstone Copper disclosure today, the economics and attractiveness of the Santo Domingo project in the context of an integrated copper district appears very compelling. This royalty at spot prices for copper potentially generates on average, 30 million a year, which is meaningful in terms of our potential growth profile. So working backwards from, well, it's great to have that potential income, but how do you get there? Working backwards, first, we would need to see a updated feasibility study in relation to the Santo Domingo project in the context of an integrated project with existing infrastructure at Manto Verde, and that's expected in the next month. And next, you'd have to see a final investment decision, which Capstone Copper has announced the target for 2025. So that puts us on track roughly for estimated first production in 27, 28. Although I think with the feasibility study update that I mentioned just now, we should have a much better line of sight on that FID date and first production date as well, which hopefully will firm up investor expectations as to the timing, but also the risk profile associated with that royalty income. You also asked about Piauí. Piauí is a very low-cost nickel project located in Brazil. We have the right, but not obligation, to invest up to 62.5 million at the time of construction. So in other words, when the project is fully financed and being built. The management team at Brazilian Nickel and the development team for POE that's been put in place is really strong, and we're really impressed with the quality of the experience and the proven ability to bring projects into first production. That team is currently working through the financing plan, and subject to obtaining CapEx financing, we're sort of watching and waiting eagerly. We think it's a great quality project, and in our view, probably one of, if not the best undeveloped nickel projects globally, certainly in terms of potential cost curve profile.
All right, I appreciate you breaking down really all three of those projects because I think they're very germane to the future of Ecora Resources and the growth profile. And again, you're really not getting a lot of value for those assets at this point. So it's a great way to play the value arbitrage for investors listening in. Another metal you have exposure to, and we've got a lot of fans of this metal on the show, Marc, and that's uranium. And I'd love you just to unpack, you've got some household names here too, Orano, Cameco, NexGen, but maybe just talk about your exposure to uranium in the basket of royalties that you hold.
Yeah, one of the things that people always think about when they think of Ecora, not everyone, but unfortunately is, oh, that's a battery play. And that's really not what we're about at Ecora. And I mentioned it already, but I can't stress it enough. What we're really looking to do is to build exposure across the energy transition piece, really including renewable energy or low carbon energy all the way down to, the EV or energy storage. And uranium is a great part of that. Our uranium portfolio has gone under the radar, frankly, for a number of years. I think in part because the uranium market was a bit more challenged, but it's certainly getting much more attention. We have exposure to Cigar Lake via a toll milling agreement, whereby for every pound of uranium processed from Cigar Lake at the McLean Lake Mill, we're entitled to a toll milling fee. We also have exposure to a producing uranium mine in Australia called the 4 Mile Mine. Longer term, we have exposure to what is earlier stage but highly prospective, and that's the SW2 region that NexGen has, which is adjacent to Arrow. So, we have a great amount of exposure from producing to longer dated early stage. Would we consider more exposure in uranium? Absolutely. But that's really within the wider commodity basket that we target.
Well, and just to the point about the wider commodity basket, you put out news just recently that you've made a new acquisition of a royalty at the Phalaborwa project. It's a rare earth project, and it's operated by Rainbow Rare Earths. So maybe just talk about the exposure you have to rare earths, and in particular, rare earths that feed the wind industry.
Yeah, so this is fresh. We announced this today, and this is a deal that we're really excited to add. I'm really excited to have in our portfolio as a royalty. So we invested 8.5 million for 0.85% gross revenue royalty. That steps up slightly in the event the project is delayed. And we've also subscribed for 1.5 million in equity. I mean, Rainbow Rare Earth shares have been subject to some of the same market forces a lot of the resource sector has. Really attractive entry point for some equity upside there as well. But in terms of the project, we've spent years looking at this commodity, amongst others, of course. But within the rare earth space, this project consistently screens out as one of the highest quality rare earth prospective producers really in the world. It's low cost, high margin project, really defensive as a result, right? That should allow it to generate cash through cycle. And furthermore, from an entry point perspective, this is really attractive. When we think about this royalty at sort of 3 years lows, it could generate in time $1.5 to $2 million at sort of through cycle pricing, three-ish. And then if you take the highs, which maybe won't last forever, but just as an indication of what the royalty could generate, you're closer to 5 or 6 million if some of the 3 year highs were sustained over a year. So it's a great royalty that has a lot of upside and gives us rare earths exposure with a really high quality project. Beyond that, though, we've talked about some of the commodities we have, but we're looking to add things like lithium, zinc, high purity manganese, graphite, and all the while we're very keen to keep base metals, and in particular copper, as our core commodity and as our core exposure.
Yeah, so even though we've talked about a big basket of commodities you already have exposure to, you're still looking to add more in the energy transition space. So we'll definitely keep our eyes peeled for more deals in the future and more acquisitions. I do want to take a quick moment, Mark, and just have you give us a snapshot of the financial health of the company, some of the top shareholders, just the share structure, anything else you want to say on the financial side of things.
Yeah, so the from a financial perspective, we're looking ahead. So we last spoke in 2023. So last year the portfolio generated approximately 65 million in royalty income or portfolio contribution. And from a volume perspective, when you fast forward to 2024, across the portfolio, we're expecting slightly higher volumes based on the guidance from all our assets. So we'll have to see how commodity prices perform over the course of this year. But from purely in terms of volumes, we should see an uptick, and that should potentially carry into 2025 as well. Again, from a volume perspective, pricing, we shall see. So on the back of that, we have a good, healthy line of cash flow, and we can do a lot with cash flow. We can, number one, delever, or number two, buy royalties that are accretive as and when they arise. Beyond that, we have a debt facility. The committed amount is 150 million, and as well as an accordion feature to take us up to 225 potentially for an acquisition. So, it's not infinite firepower by any means, but Ecora is still a relatively small company. So we certainly have the ability to do deals that in aggregate, should move the needle. In terms of our shareholder structure, our biggest shareholder today actually is South32. They took that stake as part of a partial consideration for a royalty portfolio that we acquired back in 2022. Actually, that included primarily, by value anyways, the West Musgrave royalty and the Santo Domingo royalty that we spoke about earlier today. And then from there, it's a sort of list of blue chip institutions from Aberforth, Schroders, amongst others.
All right. And then one other thing that we always get questions on is with regards to royalty companies, and you've already alluded to it there, is what will your acquisitions look like? You already mentioned the credit facility you have to do deals, but we also get questions, Mark, about dividends and share buybacks. Could you speak briefly about both those?
Well, that's certainly something that's changed 1 year on. Earlier this year in March, we announced an updated capital allocation framework, and we did that for two reasons. I think number one, the opportunity to deploy capital is really attractive. I mean, we're in market conditions that really highlight the merits of the royalty partnership as a mainstream funding source. So, what do I mean by that? Well, if you think about where most mine developers or, in fact, many producers, ex the mega caps, where these folks trade, the royalty model is really compelling. It's a great funding source. And from our perspective, one of the keys we think to being successful is when markets are choppy, we should look to deploy as much as we can and acquire the best quality royalties we can. And then when things get a bit frothy, pull back. So in that context, we've updated our capital allocation framework to prioritize growth and to add further royalties to the business that diversify our portfolio and furthermore grow it. Our focus on deleveraging remains intact. Ultimately, royalty companies should provide de-risked exposure to the mining sector, and a royalty company with too much financial leverage can erode that attraction. So, deleveraging is something that we're very mindful of. I think if you look at the business historically, you'll have seen it. We've taken on debt to fund acquisitions. We'll subsequently delever, recharge, do another acquisition, delever, recharge. So that's a trend we anticipate to continue in the future. We've maintained a cash dividend as part of this new capital allocation framework, although we've linked it to free cash flow within a range of 25 to 35% of free cash flow generation, and share buybacks. Well, with our equity trading less than half of an estimated net asset value, we felt it was a really compelling investment opportunity in its own right. And so what's not to like about the ability to increase our exposure to our portfolio of high quality royalties, especially considering where some royalties trade. So we announced a $10 million buyback program that's now completed. But as part of our capital allocation framework, I think we've been quite clear in that while we're not considering a further buyback program now, we've been clear that we'll consider buybacks in the future in the context of market price and estimated net asset value. In other words, if it's more accretive to buy back our own shares, we should think about it as opposed to going out and getting bigger for the sake of it.
All right. I think we'll wrap it up there. We've covered a lot in this one, Mark. We've covered all of the different future-facing commodities you have exposure to and some other commodities you'd like to get exposure to, some recent transaction, some producing assets, some of the development stage assets, the key roster of strategic stakeholders, the financial health of the company. You got the ability to do more transactions, to keep paying the dividend, and to possibly buy back more shares in the future. So a lot going on with Ecora Resources. And if people listening in want to follow along with the news from the company, definitely click on the link below this interview. It takes you right over to the company website, directly to the news section. Marc, keep us abreast of other news as it comes out. We'll get you back on the show for an update. And as always, looking forward to our next conversation.
Yeah, likewise. Look forward to speaking soon.